How to profit from the debasement trade. Currency debasement happens when the value of money declines relative to goods, services, or other currencies. It's not necessarily visible at first. After all, your $100 bill still says $100. But what it buys steadily decreases. Debasement can occur through monetary expansion. Central banks increase the money supply faster than economic output. Fiscal spending. Governments finance deficits by issuing debt or printing money. Negative real interest rates. When inflation outpaces nominal yields, holding cash or bonds loses real value. Essentially, debasement means more money chasing the same or fewer goods. Prices rise, purchasing power falls, and those holding fiat currency suffer a stealth tax through inflation. The concept is ancient. Historically, debasement began with coins. Rulers diluted gold or silver with cheaper metals to mint more coins, stretching the same reserves over more currency units. This provided short-term fiscal relief but long-term economic decline. Rome famously debased its silver denarius from 95% silver under Emperor Augustus to less than 5% by 268 AD. Prices skyrocketed, confidence collapsed, and trade suffered. In modern economies, the mechanism is digital, not metallic. Instead of mixing metals, governments print or create new money electronically. While this stimulates spending temporarily, over time it dilutes the currency's purchasing power. Today's debasement is driven by central banks. When they adopt quantitative easing, lower interest rates to near zero, or monetize government debt, they increase liquidity in financial systems. Initially, this supports markets. But as liquidity outpaces productivity growth, inflation pressures mount. Debasement then becomes visible through rising consumer and asset prices, declining real wages, and devaluing currency on foreign exchange markets. For traders, these signals indicate that it's time to consider positioning for a debasement trade. The debasement trade strategy is designed to profit from inflationary and currency devaluation environments. It's based on the understanding that when money supply expands faster than economic growth, fiat currency loses value relative to real assets. Traders implementing this strategy typically move capital away from cash and bonds into tangible or inflation-hedged assets, such as gold, commodities, real estate, and certain equities. At its core, the debasement trade involves shorting fiat money in favor of hard assets. It's about aligning with real value instead of nominal promises. When central banks print excessively, real assets appreciate in nominal terms. Gold, oil, and agricultural commodities often rise during debasement phases. Stocks of companies that own or produce real resources also benefit. A simple example: if inflation rises and the US dollar loses value, holding gold, which maintains intrinsic value, allows traders to preserve and even increase purchasing power. Traders monitor several indicators to detect debasement risks early. M2 money supply growth. Rapid expansion suggests an oversupply of money. Real interest rates. When inflation exceeds nominal rates, real yields turn negative. Fiscal deficits and debt levels. High debt to GDP ratios imply reliance on monetary financing. Central bank balance sheets. A rising balance sheet signals ongoing money creation. Consumer price index and producer price index trends. Sustained inflation pressures confirm currency weakness. When multiple indicators align, the conditions for a profitable debasement trade are present. Just a quick reminder to please hit the like button and subscribe to the channel. Also, you can visit us on the web at www.investmenttees.com and use code BLOG to receive 25% off your next purchase. Implementation depends on asset class, time horizon, and risk tolerance. Debasement trades can be executed through forex positions, commodities, equities, or diversified macro portfolios. In Forex, traders look for currencies at risk of losing purchasing power relative to stronger or more disciplined economies. If the US increases money supply aggressively while Switzerland maintains tight policy, the US dollar versus the Swiss franc pair becomes a candidate. Traders short US dollar and amp, the Swiss franc to profit from a falling dollar. Another method involves going long commodity-backed currencies like the Australian dollar or Canadian dollar, as they tend to rise when inflation drives commodity demand. Traders also analyze real interest rate differentials. Currencies with positive real yields usually outperform those with negative ones during debasement phases. Gold and silver remain classic debasement hedges. They are finite, globally recognized, and historically retain value when fiat systems falter. During the 1970s and post-2008 periods, gold outperformed equities and bonds, driven by investor demand for real stores of value. Traders can implement exposure via physical metals or storage accounts, exchange-traded funds like gold or silver and amp, with futures contracts for leverage and short-term trades. Because precious metals have no counterparty risk, they're often viewed as the purest debasement trade. Equities can also serve as inflation hedges, especially those in sectors tied to tangible resources. Energy, mining, and agriculture tend to outperform when currencies weaken. For example, during 2020 to 2022, oil companies and miners like ExxonMobil, Rio Tinto, and Barrick Gold saw strong gains while global currencies weakened due to stimulus policies. Traders can also focus on companies with pricing power, firms that can raise prices without losing customers. Consumer staples and industrials often fall into this category. Profiting from debasement requires correct timing, asset allocation, and conviction in the macro thesis. As fiat currency weakens, assets priced in that currency generally rise. Traders who hold these assets capture that appreciation while avoiding losses in purchasing power. When inflation accelerates, investors reprice assets. Bonds and cash lose appeal. Commodities, real estate, and equities rise. By entering before inflation becomes mainstream news, traders gain from both price appreciation and increased demand for inflation hedges. An example: between 2009 and 2011, following QE1 and QE2, gold prices jumped from around $900 to over $1,900 as liquidity flooded markets. No strategy is risk-free. Debasement trades can underperform if inflation expectations cool or central banks suddenly tighten policy. Smart traders use stop losses to limit downside, options to hedge exposure and amp, diversification across asset types. It's also wise to scale into positions gradually as macro trends confirm. Some real-world debasement examples can be found during the 1970s inflationary period. After the US abandoned the gold standard in 1971, inflation surged. Energy shocks compounded the effect, pushing CPI to double digits. Traders who held gold or oil-linked assets saw extraordinary gains. Gold soared over 2,000% that decade, proving the effectiveness of the debasement trade. Post-2008 era. Following the global financial crisis, central banks injected liquidity through quantitative easing. While deflation was the initial concern, the long-term result was asset inflation. Gold, equities, and emerging market currencies appreciated as investors sought refuge from fiat debasement. The COVID-19 and 2020s boom. In 2020, massive fiscal and monetary stimulus unleashed unprecedented liquidity. The M2 money supply in the US expanded by more than 25% in 1 year. Gold, Bitcoin, and commodities rallied, reflecting widespread expectations of currency debasement. This era demonstrated that the debasement trade can thrive even in modern digital economies. Benefits and risks of the debasement trade. Hedge against fiat devaluation. The debasement trade protects against the erosion of money's real value. Instead of holding cash, traders own assets that benefit from inflation or currency weakness. It's a natural defense mechanism in an era of debt monetization and perpetual stimulus. However, the strategy carries timing risk. If central banks shift to tightening or deflationary policy, inflation-sensitive assets may correct sharply. Traders must monitor interest rate changes, inflation data, and fiscal announcements closely to avoid entering too early. Building a debasement trade portfolio consists of asset allocation for debasement. A well-structured debasement portfolio typically includes 30 to 40% gold and silver exposure, 20 to 30% commodity-linked equities, 10 to 20% foreign currency exposure, and 10 to 20% inflation-protected bonds. The goal is to balance inflation-sensitive assets with hedges that maintain liquidity. ETFs like GLD, SLV, and DBC make the strategy accessible to retail traders. Forex positions in Australian dollar, US dollar, or the Canadian dollar, Japanese yen can add diversification. Some traders also include Bitcoin or Ethereum, viewing them as digital gold. However, these assets are volatile and require careful risk management. Conclusion: the debasement trade represents a timeless principle. Paper currencies are only as strong as the discipline of those who issue them. When that discipline erodes, traders who position early in real, scarce, or inflation-resistant assets can profit substantially. From ancient coinage to digital money, debasement has repeated throughout history. The tools have changed, but the outcome remains the same in those who understand and act on it prosper. To succeed, traders must stay informed, monitor monetary trends, and approach the strategy with patience and conviction. The debasement trade is not just about speculation. It's about safeguarding and growing wealth in an era where money itself loses meaning. Thanks for watching.